Hi everyone, I'm Jerry Davidsey, CEO of Presilium Private Wealth. Welcome to Financial Planning Fridays, our weekly video series on financial planning where we work to simplify wealth management decision-making for our clients so they can focus on what is most important to them. In our 28th Financial Planning Fridays episode, I wanted to talk about recessions. Since at least the middle of last year, there has been constant debate about whether the U.S. economy is in a recession or is about to enter one. The term recession can strike fear into the hearts of investors, and for good reason. Recessions are periods of economic decline, typically characterized by a decrease in economic activity, rising unemployment, and falling stock prices. Because of this, for many people, the instinct during a recession may be to sell off their investments and hold on to cash until the economy recovers. However, history has shown that staying invested in stocks during a recession can actually be the right move. First, it's important to understand that the stock market is not the same as the economy as a whole. While the economy may experience a downturn during a recession, the stock market is not necessarily a reflection of the entire economy. In fact, sometimes stocks recover well before the broader economy does. Another reason to stay invested in stocks during a recession is the potential for buying opportunities. When stock prices fall, many investors may panic and sell off their holdings. However, for those with a long-term strategy, like us, a market downturn can present a great opportunity to buy stocks at lower prices. Finally, it is worth noting that stock prices tend to be forward-looking. That is, the market is not just a reflection of the current economic conditions, but also of expectations for the future. During a recession, many companies may struggle in the short term, but the market may already be factoring in expectations for future growth once the economy begins to recover. By staying invested in stocks, an investor can potentially benefit from the market's long-term outlook and position themselves for future growth opportunities. Let's look at the data from the 13 U.S. recessions since World War II. The average length of a recession has been 10 months, ranging from 2 months up to 18 months long. This chart shows the annualized return of an investment made in the S&P 500 right at the start of each of those recessions. The average annualized return was about 5.5% during the actual recession. Not bad, and probably not a reason to change your long-term strategy. Now, let's look at the returns over slightly longer time frames. We calculated the returns based on an investment made in the S&P 500 the month the recession started. The cumulative returns are as follows. 1 year after the start of a recession was 6.7%. 2 years after the recession started was 24.6%. And 3 years after the recession started was 38.2%. Looking at this, it not only makes sense to hold your investments through a recession, but to add to them if you can. Once again, it is amazing how the market continues to move up over time, even through temporary economic crises, uncertainty, and recessions. Thank you, and we look forward to talking with you soon.